guys, Sandy Guide here with Harbor One Mortgage. It is a beautiful day today, so I wanted to sit outside and shoot this video. I wanted to talk today a little bit about the debt to income ratio. I'm sure a lot of people have heard about the debt to income ratio before, and you generally have an idea of what it is. It's the total amount of debts divided by the total amount of your income. Gives you a percentage, and when you're applying for a loan, lenders look at the debt to income ratio to see if you qualify for a type of loan, and generally we have parameters that we have to stick to or that you have to be under to meet the program guidelines. So what I wanted to talk about today is just a little bit more detail about what debts are included or considered when you're applying for a mortgage, and how the income is calculated or what type of income we use when we plug in the numbers for your debt to income ratio. So if that's something that you're interested in, stay tuned. So with the debt to income ratio, the first piece is your debts. So the first place we look is on your credit report. So any of the debts that show up on your credit report, we will take those monthly payments and use it in the debt to income ratio. If you're curious about what's reflected on your credit report, you can go to www.annualcreditreport.com and you can pull a free copy of your credit report once every 12 months. And there's 3 credit bureaus, so you can pull theoretically 3 per year or 3 per 12-month period. Or you can pull all of them at once, whatever floats your boat. But so I would recommend, if you're curious about your debt to income ratio, go to that website or somehow get a copy of your credit report and take all of your monthly debts, take the monthly payment amount and plug that in. So that's one piece of it. The other thing that we do use in the debt portion is anything like child support payments that you make monthly, alimony payments, separate maintenance. Those all get included. If you own any properties or land, the principal, interest, taxes, and insurance of those properties or land usually will be included in the debt to income ratio. There are times where they don't need to be, but just to be on the safe side, include those in your debts. And then if you have any private mortgages or private loans, say, you took a loan from your mom and she wrote a note that you all signed, and it is binding, but it's not reflected or reported to the credit reporting agencies. It's not going to show in your credit report, but that's something that we would include in your debt to income ratio. When you're applying for a mortgage, we're also going to include the mortgage payment of the house you are looking to purchase. So that's going to be the principal, interest, taxes, insurance. If it's a condo, the condo fee, and if you're in a flood zone, we're going to take into consideration the flood insurance premium. So keep all that in mind. So once you have all of those debts, you're going to divide that by your total monthly income. So we use the gross monthly income, so before taxes. So a simple example is if you are a full-time employee making hourly wage, you would take your hourly rate times 40 hours a week times 52 weeks in a year, divide that by 12, and that is your gross monthly income. If you have variable income, there's a little bit of a different calculation there. We typically will use a 2-year average. If your income is declining, so say you made a little bit more in 2021 than you did in 2022, we're going to use the lesser of either. So if you made less in 2022, if you're looking at your year-to-date and figure out what the monthly amount is, then we're going to use the lesser. If you made less in 2021 and more now, we're going to use an average. But the important thing to keep in mind is that it's the gross monthly income, so before taxes are taken out, before any of your health insurance or medical or social security taxes or any of that's taken out, we get to use your gross monthly income. If you're self-employed, though, that income calculation can be a little bit tricky. So if you needed help with that, feel free to give me a call, DM me, email me, and I can help you figure that out. But the important thing to remember is that it's the gross monthly income and not the net. In terms of mortgage qualification, what we generally like to see you under is about a 41% total debt ratio, including all of those debts, including the payment of the property you're trying to purchase. That's what we'd like to see, but there are a lot of times where we can go higher than that. So, typically I'll see approvals going through at less than a 50% debt to income ratio, and once in a while, rare exceptions, they even go up to 55%, but don't count on it. If you're under a 41%, you're generally in the safe zone, and if you're higher than that, it can get it depends on a lot of other factors in your profile. One other thing to keep in mind is that we do not include the debts such as utility bills, grocery bills, childcare expenses. Although if you are applying for a VA loan, they do take childcare expenses into consideration. But I get that question a lot about whether or not we will consider utility bills and things like that, so we don't. I hope this video helped clarify any misconceptions about what's included in a debt to income ratio, and maybe helps you try to figure out what yours is. This is kind of nice to know if you're kind of thinking about buying a house, but you're not ready to apply, and kind of curious about what your debt to income ratio might be based on the types of mortgages you're looking at or the loan amounts that you're looking at. So hopefully this helps. If you have any questions or want any help figuring yours out, I'm here. You can call me, DM me, email me. I'm available, and I would be more than happy to help. Thank you for watching, and have a great day.